Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, May 18th, 2026, and we're seeing some notable pressure across markets as geopolitical tensions and bond market concerns weigh on sentiment. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story this morning is the confluence of rising geopolitical tensions and bond market disruption that's creating a risk-off environment across asset classes. We're seeing US-Iran tensions escalate, which has pushed oil prices sharply higher, and that's translating into what some analysts are calling a $40 billion fuel bill hitting American consumers. This oil shock is particularly concerning because it's happening simultaneously with a significant bond market sell-off driven by inflation fears. Treasury yields are surging, and that's putting real pressure on the logic behind the recent fears. Equity rally. What's interesting is how this is playing out across different market segments. The bond vigilantes are back, and strategists are suggesting they might force a more hawkish policy pivot than markets have been pricing in. We're also seeing corporate earnings updates that are somewhat mixed. Venture Global and Viper Energy both delivered strong Q1 results and raised their 2026 guidance, which shows some underlying strength in the energy sector. But retailers are facing one battle after another, according to the latest reports. There's also notable activist activity, with Elliott building a significant stake in Bio-Rad, the life science tools supplier, which could signal some interesting corporate governance changes ahead.
That's a complex picture with multiple crosscurrents. How are you reading the market's interpretation of these developments?
The market interpretation is clearly defensive right now. What we're seeing is a shift away from risk assets, as investors digest the implications of persistently higher yields combined with energy price shocks. The key concern is whether corporate earnings can continue to justify current valuations when borrowing costs remain elevated and input costs are rising through energy prices. The retailer struggles are particularly telling because they highlight the consumer pressure from higher fuel costs and persistent inflation. On the positive side, the energy sector strength and companies like Venture Global raising guidance suggest there are pockets of opportunity, but investors need to be selective. The activist involvement at Bio-Rad is also worth watching because it often catalyzes value creation. And in this environment, companies that can improve operational efficiency and capital allocation will likely outperform. The broader theme is that we're moving from a period where rising tides lifted all boats to one, where fundamental analysis and sector selection really matter.
Let's talk technicals. How are the major indices positioned right now?
Looking at the technical picture, the S&P 500 is showing some concerning signs. We're testing support levels that have held for the past few weeks. And with stock futures slipping this morning amid Mideast pessimism, we could see a break lower. The index is caught between the rising yields creating valuation pressure and the geopolitical premiums supporting energy names. I'm watching the 5,100 level closely as a key support zone. For the Nasdaq, the situation is even more delicate because tech stocks are particularly sensitive to rising yields given their longer duration cash flows. We've seen the logic behind the tech rally being questioned, and if the 10-year yield continues pushing higher, we could see further multiple compression. The Nasdaq needs to hold above its 50-day moving average to maintain the bullish structure. The Dow is actually showing relative strength due to its heavier weighting in value stocks and industrials, which tend to perform better in rising rate environments. However, even the Dow is feeling pressure from the broader risk-off sentiment. Overall, all three indices are at inflection points, and the next few sessions will be critical in determining whether we're seeing a healthy pullback or the start of a more significant correction.
What does this environment mean for traders and investors practically?
For traders, this is an environment that demands discipline and risk management. The volatility is creating opportunities, but you need to be nimble and avoid overexposure. I'd be looking at energy sector names that benefit from higher oil prices, particularly those with strong balance sheets and the ability to return cash to shareholders. The Venture Global and Viper Energy earnings show there's money to be made in that space. On the defensive side, consider reducing exposure to high multiple growth stocks that are vulnerable to further yield increases. For longer-term investors, this pullback could present buying opportunities, but I'd wait for clearer signs of stabilization before deploying significant capital. The key is to focus on quality companies with pricing power that can pass through higher costs to customers. Also keep an eye on the bond market, because if yields stabilize or start to decline, that could be the all-clear signal for risk assets. The one area I'd be cautious about is retailers facing margin pressure from both higher costs and potentially weakening consumer spending. Selectivity is absolutely critical right now, and having some cash on the sidelines to take advantage of opportunities as they develop makes sense.
Shifting to digital assets, Lizzie, what are the latest trends in the crypto market?
The crypto market is facing significant headwinds heading into next week, and we're seeing bearish to neutral sentiment across the board. Bitcoin is showing particular weakness after spot Bitcoin ETFs recorded $1 billion in outflows over the past week. Breaking a 6-week inflow streak, that's a major shift in institutional sentiment. BTC has slid from around 79,000 down to 77,000, and we're now testing 2-week lows. The geopolitical tensions we discussed earlier are hitting Bitcoin as a risk asset. despite the interesting development of Iran reportedly considering Bitcoin-based insurance schemes for Strait of Hormuz shipping. For next week, I'm looking at a bearish outlook with a target range of 74,000 to 79,000. The key catalysts to watch are the Fed minutes release and any changes in Treasury yields. Ethereum is facing even more pressure with a bearish outlook and a target range of 2,800 to 3,200. Tom Lee specifically identified surging oil prices as driving Ethereum selling pressure, and there's a concerning bearish Adam and Eve pattern forming that suggests potential further downside. The DeFi exploits, including the Varus bridge being drained of 11.6 million, aren't helping sentiment either, though we are seeing some recovery with Aave restoring Gweth borrowing limits. Solana is mixed to bearish with a target range of 180 to 220. The positive development is Jump Crypto's fired answer, quietly hitting mainnet, though validators must wait for full deployment. However, Goldman Sachs exiting Sol ETF exposure in Q1 and the broader 5% decline in recent selling are concerning. A Sol lost 500 million in long liquidations as part of the broader 563 million crypto liquidation event.
What's your read on institutional versus retail positioning in Bitcoin right now?
The institutional versus retail dynamic in Bitcoin is particularly interesting at this moment. On the institutional side, we're seeing divergence. The 1 billion in ETF outflows signals that some institutional money is rotating out, likely due to the rising yields making fixed income more attractive, and the geopolitical uncertainty creating a risk-off posture. However, we're also seeing selective buying from players like Capital B, which just deployed 15.2 million into Bitcoin purchases, and Michael Saylor signaling potential BTC buying opportunities. This suggests that long-term institutional believers are viewing current weakness as an accumulation opportunity. The advancement of the US Clarity Act is creating what Santiment calls a major spike of euphoria among the institutional regulatory-focused crowd, because clearer rules make it easier to allocate. On the retail side, the 563 million in liquidations tells us that retail was heavily positioned long and got caught wrong-footed by the quick move lower. Retail tends to chase momentum, and many likely bought into the recent strength only to face margin calls as Bitcoin broke below 78,000. The retail holders are also getting pushed on dividend votes and other governance issues, which shows increased engagement, but also suggests some may need to sell to meet liquidity needs. Overall, smart institutional money appears to be selectively accumulating while momentum-driven retail is getting shaken out. This kind of washout can actually set up better conditions for a rally once the macro headwinds subside, but for next week specifically, the technical damage and outflow trends suggest further near-term pressure before we see a sustainable bottom.
Thanks to both Lizzie and Steve for those insights. As we navigate these complex market conditions with geopolitical tensions, rising yields, and shifting sentiment across both traditional and digital assets, it's important to stay informed and adaptable. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell to stay updated on the latest market developments. We'll be back tomorrow with more analysis. Until then, trade carefully.